Ladies and gentlemen, I am extremely honored to take the floor in front of you today to speak about Islamic finance from a global viewpoint. This subject is extremely rich and can be approached through a number of angles. Of course, my presentation will not be complete. My goal today is to try and explain in very general terms the foundations, the present situation, and the possible future of the Islamic financial services industry, knowing that the other presenters will shed light on the contribution of Islamic finance to economic development, and will also speak about the particular situations in Morocco and Tunisia. But allow me in the first place to say a few words about the Islamic Development Bank, my institution. The IDB was established in 1975 to foster socio-economic development in its member countries in compliance with Sharia. Sharia, it's a word that we will try to explain a little bit later. The IDB has an authorized capital of a little bit more than $45 billion and a subscribed capital of $27.4 billion. It enjoys a AAA rating from Standard & Poor's, Moody's, and Fitch, and is considered as a zero-risk weight institution by the Basel Committee. Like other multilateral development banks, its main strategic objective is to fight poverty, and we have 6 areas of priority that are probably posted here in the screen. The IDB has 56 member countries, all from the OIC, the Organization of Islamic Conference, from Malaysia, ranging from Malaysia to Morocco, including countries like Indonesia, Nigeria, Saudi Arabia, etc. The net cumulative financing of the IDB since its inception till the end of 2011 is $78 billion. And of course, the IDB does work closely with a number of multilateral development institutions like the African Development Bank, the World Bank, the Asian Development Bank, the EIB, etc., as well as with bilateral donors such like the Arab funds, the Agence Française de Développement, etc., for enhancing development in its member countries. Now, let's get to some history now to discuss the principle of Islamic banking. The cornerstone in this regard is rooted in the fact that Islam does not authorize financial dealings that involve riba. And this is a word also to remember, and we will try to explain that. There is almost a general consensus among religious scholars, which are the ulama. I will post a glossary later on for you to follow these terms that probably are very new to you. So there is a consensus among the Islamic religious scholars that riba is considered to include not only usury, but also interest as well. Of course, Islam is not the only religion that retains this viewpoint. You may remember that in the Old Testament, the Torah and Talmud did denounce usury and encourage the granting of loans if they don't involve interest, with certain exceptions. We also know that for 1,500 years, the church banned charging interest. It's only in medieval times in Europe that a new approach to the practice of interest started to emerge, linking interest with the notion of compensation to a loss or an expense. But let's come back to the notion of Sharia. What is Sharia? We will stop a while to shed light on this notion, which in the West has taken some kind of blurred connotation. And to simplify, I will say that Sharia is the set of rules derived essentially from both the Quran, which is the holy book of the Muslims, and the Sunnah, and in particular from the hadiths or sayings of the Prophet. Hence, Sharia compliance in modern Islamic finance is to do with the development of financial tools and services that are in conformity with the ethics of Islam, which place equity and justice at their heart. The translation of this ethical code into commercial and financial activities can be summarized into 5 main points. I have shortened this list on purpose. There are many other points, but I am concentrating on 5 main elements. 1, it is prohibited to charge any payment over and above the actual amount of principal of a loan. Islam allows only one kind of loan, and that is qard al-hasan, literally good loans, whereby the lender does not charge any interest or additional amount over the money lent. More than that, any associated or indirect benefits from a loan are prohibited. 2, one cannot make money from money. Money is only a medium of exchange in the Islamic point of view, a way of defining the value of a thing. It has no worth in itself, and therefore should not be allowed to give rise to more money via interest payments. In other words, money is a potential capital that becomes real capital only when invested. Number 3, Muslims are encouraged to invest their money and to become partners in order to share profits and risks in the business instead of becoming mere creditors. Number 4, gharar or uncertainty, risk or speculation is also prohibited. Under this prohibition, any transaction entered into should be free from excessive uncertainty, risk, and speculation. Contracting parties should have perfect knowledge of the counter values intended to be exchanged as a result of their transactions. Consequently, in Islamic finance, derivative contracts are forbidden because of the uncertainty involved in the future delivery of the underlying asset. Finally, number 5, investments should only support activities or products that are not forbidden or even discouraged by Islam. For instance, trade in weaponry, gambling, or alcohol, for example, could not be financed by an Islamic bank. Now, let's take a look at the growth of the Islamic financial services industry, and let's see when did it emerge. Since its early years in the 60s and in the 70s, where the first modern Islamic finance institutions started to be created, Islamic banking grew steadily. And recently, growth has accelerated spectacularly, so that between 2006 and 2011, assets of Islamic commercial and investment banks, takaful companies, we'll explain what takaful is a little bit later, and asset management companies grew by 64.46% between 2006 and 2011, thus showing a compound annual growth rate for the period concerned of more than 20% per annum. According to Standard & Poor's, the said assets are expected to exceed $1 trillion at the end of this year. So what are the reasons for these expansions? I see 3 main reasons. Number 1, the expansion is linked to a demand. Obviously, there is a very, very important demand in all Muslim countries for this kind of products that are considered licit and in accordance with the beliefs of the Muslims. Number 2, prudent risk management policies can also explain the growth of this sector. And number 3, the expansion can be linked to the fact that operations are backed by real assets. And this is something I think very important also to remember. And consequently, this has helped safeguard Islamic banks from the credit crisis. I have, Paula, if you don't mind, I have a table, yes. Here, derived from a document of the International Islamic Financial Market, which is a regulatory institution. We can clearly distinguish the different phases of this progression. As you can see, the increase in volume was accompanied by an increased diversification on the surplus side. In the beginning, the activities were limited to development banking and commercial banking, and you see that nowadays the array of products and services is much more diversified. We find Islamic finance in Islamic countries and in non-Islamic countries. The member countries of the GCC, which is the Gulf Cooperation Council, concentrate around 45% of Islamic finance, while Malaysia is the largest single market for Sharia-compliant assets outside the Middle East, with 10% of total assets. For motives that will be explained by my colleagues later on, Islamic finance remained very timid in Maghreb countries so far. We also note that the market for Islamic finance as a source of financing of large-scale projects, and project finance, and particularly PPPs, has mushroomed in recent years. Very complex deals in the MENA and Southeast Asia regions in energy, highways, IPPs, etc., are increasingly featuring Islamic trenches to the delight of lawyers, and particularly of British lawyers. Now, Islamic finance in non-Muslim countries, similarly, Sharia-compliant financing, or SCF, as it has started to be called, is more and more present in non-Muslim countries. It's interesting in this respect to observe that the UK accounts for 2.5% of global SCF market. The UK has several Islamic banks, the first of which, the Islamic Bank of Britain, IBB, was granted a license in 2004 by the FSA. Other countries that have made inroads into Islamic finance in recent years include Thailand, Singapore, Japan, South Korea, Hong Kong, and Australia. Several famous conventional banks such as HSBC, Deutsche Bank, JP Morgan, and Paribas, to name just a few, have opened Islamic windows through which they offer SCF as well. There is growing interest also for Islamic finance and business opportunities for lenders in the USA. Lariba, American finance house, offers SCF products since 1987. Freddie Mac deals in Sharia-compliant mortgage contracts. Also, Sharia-compliant mutual funds are offered by intermediaries such as the Dow Jones Islamic Fund. A fourth example, in 2009, General Electric became the first major US company to sell a 5-year, $500 million Islamic bond issue. At this point, let us see what are the main Islamic funding structures and financial vehicles. The Islamic financial services industry can be defined broadly to include onshore and offshore commercial and investment banks, leasing companies, private equity, venture capital vehicles, takaful and re-takaful operators, Islamic capital markets and their players such as brokerage houses, Islamic asset management companies, etc., and Islamic microfinance institutions. I will rapidly mention also some of the techniques of the trade, knowing that probably my other colleagues will also talk about these techniques. Paula, if you don't mind, can go back to the glossary. Yes, probably here. The first one is musharaka. Musharaka, I will be very brief in those definitions because I don't want to get into too many technical explanations, but we can come back later to each of these techniques. Musharaka is a partnership between an Islamic bank and a client in which both share the equity capital and the management, but sometimes the management is in the hands of the bank, of a project or deal, and both share in the profit or losses according to their equity shareholding. So it's a joint venture. You have a diminishing musharaka, which is equivalent to musharaka, with the bank gradually selling its share to its partner at an agreed price and in accordance with an agreed schedule. Another technique is ijara, which can be compared to a leasing contract. Another one is mudaraba. Mudaraba is a contract between a capital owner and an investment manager. Profits are distributed as per a ratio that they determine at the time of the contract. Losses are borne by the capital owner. Number 5, istisna. In an istisna operation, a client orders the bank to manufacture or build, then provide an asset, the description of which, delivery date, price, and payment date are all set in the contract. Repayments are made in installments. A few words on the murabaha. This is a sales contract at a profit markup whereby the client orders a bank to buy on his behalf a determined asset at a specific price, promising to purchase this asset at a price to be repaid through installments, which includes, obviously, an agreed profit margin. Now, takaful and retakaful. Most ulama, i.e. most scholars, Islamic scholars, do not consider conventional insurance to be in line with Sharia, as it contains an element of gharar, uncertainty, as we said earlier. It contains also an element of maysir, which is gambling, and it contains interest or riba. Takaful in Arabic means guaranteeing each other. So takaful is a cooperative mechanism where members contribute money into a pooling system, a mutual fund, in order to guarantee each other against loss or damage. And at the end of every fiscal year, any remaining surplus will be returned to the policyholders in the form of cash dividends or distributions. It's interesting to note that Ernst & Young's World Takaful report that they issue regularly indicated that the Takaful industry is expected to grow threefold from an estimated $9 billion in 2009 to $25 billion by 2015. Lastly, a few words on microfinance. This is a rising niche. A growing number of Sharia-compatible microfinance institutions have emerged to serve low-income Muslim clients who demand projects consistent with their faith. And all of the techniques that we mentioned earlier can also be used for microfinance. I would like to shed some light on Islamic capital markets. They are dominated by sukuk. I think everybody has heard this word before, which are economically equivalent to bonds, but are legally structured differently. They are structured as a security that distributes cash flows arising from a set of underlying assets, such as real estate properties or business. Total sukuk issuance in 2011 is estimated to be over $84 billion, corresponding to an increase by 62% from their level of 2010. The sukuk market is expected to exceed $100 billion this year. Malaysia constitutes the main sukuk market worldwide, followed by the GCC. There has also been a number of sukuk issued in non-Muslim countries, and the trend is accelerating. Companies in Europe are considering issuing Islamic bonds to tap Middle Eastern investors, and conversely, Middle Eastern investors are keen to put their money into Western companies and spread their risk away from domestic investments. I would like to speak a little bit about Sharia Committees. This is an interesting feature in Islamic finance institutions. All the institutions, these institutions, i.e. Islamic finance institutions, have to be in conformity with Sharia, and most of them have a committee composed of religious advisors whose opinion is sought on the acceptability of new instruments and who have to provide the religious audit of the institution's end-of-year accounts. Let's move into the regulatory architecture of the Islamic financial services industry. And clearly, such an emergent market and such an ensemble of different institutions and new techniques needed to be organized within a general structuring and regulating umbrella. And hence, during the last 2 decades, new multilateral institutions were created to back the young Islamic financial services industry with a view to facilitate monetary and financial policy making at the national level, and also to promote financial stability, international integration, and growth. And my institution, the Islamic Development Bank, has played a significant role in the development of this infrastructure. Here are the main bodies. Number one, the oldest one, is the Accounting and Auditing Organization for Islamic Financial Institutions, AOFI. AOFI was established in Bahrain in 1990 by several institutions and the IDBs, as I said, to develop accounting and auditing Sharia standards. In addition, AOFI also provides professional qualification programs to enhance the industry's human resource base and governance structures. Another institution is the Islamic Financial Services Board. The IFSB was established in Kuala Lumpur in 2002 by a number of central banks with the support of the IMF and the IDB to provide for prudential standards and guidelines for international supervision of Islamic banks. There is also the International Islamic Financial Market. I'm going to try to speed up a little bit. The General Council for Islamic Banks and Financial Institutions, there may be a few words on this one, CIBAFI, which was established in 2001 in Bahrain to support the industry through awareness creation and training. And they issue certificates in several disciplines related to Islamic finance. Some of our colleagues here around in this panel have certificates from CIBAFI. There is also the Liquidity Management Center, because there is a very great difficulty in the Islamic financial institutions in terms of liquidity management. So the LMC, the Liquidity Management Center, is trying to create an interbank market at the national and international levels. A few words also on the Islamic finance and global institutions. The International Monetary Fund is offering valuable support to countries that want to introduce Islamic finance. The IMF provides central banks and supervisory authorities with insight into Islamic instruments and help them put in place the requirements for supervision and oversight of Islamic finance. The World Bank Group, its support for Islamic finance cuts across all its institutions. For instance, both the IBRD and IFC have issued sukuk, and also the MIGA, which is the Multilateral Investment Guarantee Agency, has started to co-guarantee projects with the IDB group. The Asian Development Bank, this institution and the IDB established in 2009 a $500 million Islamic infrastructure fund. Now they have started the second one that contributed Sharia-compliant equity investment in 12 common member countries. And they also provide guarantees for Islamic financing deals. Closing remarks, I will conclude by 4 closing remarks. Firstly, the impressive growth of all the segments of the Islamic financial services industry should not mask the fact that it constitutes only a very small portion of the global finance market. As we indicated, the total assets worldwide of Islamic finance institutions are believed to be around $1 trillion at the end of this year. But let us just keep in mind that the assets of JP Morgan Chase in 2011 were with $2.2 trillion, more than twice this amount. Secondly, and since only few Muslim countries have adopted so far this type of finance, and as a result of the growing demand in Western and Asian countries, it seems that expansion of Islamic finance is to continue at a robust rhythm. Thirdly, the Islamic finance industry operates in markets that are connected to the world economy, and hence, despite its intrinsic built-in characteristics, cannot be completely sheltered from the ups and downs of international markets. And finally, overall supervision, both at country and international levels, need to be reinforced. Risks need to be constantly monitored by central banks and regulators and properly mitigated to minimize the vulnerability of Islamic finance institutions, and in particular, capital adequacy standards may be revisited to look into the need for more capital in these institutions. Thank you, Mr. Chairman.
Thank you very much for your presentation.